How should our audience of retirement, of personal finance, how should they synthesize the Fed madness? You and I remember when Arthur Burns had smoke coming out of the pipe and we interpreted that. Now we've got this parlor game. How does Ed Yardeni filter that if it's for long-term investment?
Well, I think you focus on the economy. If you believe in the resilience of the economy, if you believe that the labor market is in balance, we got a 4.3% unemployment rate, which is awfully good. We have an inflation problem. The Fed is going to have to probably raise interest rates at least once, maybe a second time, maybe even a third time, according to where the two-year Treasury note yield is right now. I think you kind of grin and bear it and try to enjoy your retirement life, because I think the market will continue to defy the bears, because the economy will continue to defy the pessimists.
You were saying that the boomers don't care about the Fed raising rates. They're going to enjoy their retirement. I'm not a boomer. I'm a Gen Xer, so I got to work for longer. And I'm wondering whether a higher for longer interest rates means that I have to rethink, reassess, pivot my investment strategy.
Well, the short answer is yes, but I'm not a big fan of the higher for longer idea about interest rates. I think interest rates are back to normal. In other words, 4 to 5% 10-year Treasury bond yield is a sign of a very healthy economy. It's a yield that made sense before the great financial crisis. The aberration, higher for longer implies we're going to be going back to closer to zero interest rates. This is it. This is pretty
That was the abnormal.
Yeah. Now 6.5%, 7% mortgage rates seem awfully high to a lot of people. Compared to what? Compared to where they were when the economy wasn't doing so well.